This is not about money. This is about why smart people stay poor. $1,000. That's all I put in. Not into a business. Not into crypto. Not into some hot stock a stranger told me about on the internet. I put it into the S&P 500, the most boring investment on planet Earth. And what happened next? Broke every belief I had about money. Because somewhere between day one and today, I didn't just watch a number go up or down on a screen. I watched myself. I watched my own fear, my own greed, my own impatience. I watched the parts of me that were never taught in school, the parts that decide whether you become wealthy or whether you stay stuck forever. Because here's the truth nobody tells you. The stock market is not a casino. It's a machine. And that machine doesn't care about your dreams. It doesn't care about your rent. It doesn't care that you need this to work. It only does one thing. It tests you. Stay with me. Because by the end of this video, you will understand exactly why most people lose money in the market, even when the market itself is designed to make them rich. Let's begin. The machine. Imagine a machine. Not a machine made of metal. A machine made of money. Every second, billions of dollars flow through it. Buying, selling, rising, falling. This machine has existed for over 100 years. And in that time, it has made more ordinary people wealthy than any lottery, any business, any job ever has. But here's what nobody tells you about this machine. It's not designed to reward the smart. It's designed to reward the patient. And it's built, almost perfectly, to punish everyone else. Think about that for a second. You don't need a genius IQ to win in this machine. You don't need insider information. You don't need to predict the future. You just need to survive your own mind long enough to let the machine do its work. That's it. That's the entire game. And yet, 90% of people who enter this machine walk away with less than they started with. Not because the machine failed them, because they failed themselves. So when I put my $1,000 into the S&P 500, I wasn't just buying a piece of 500 American companies. I was stepping into the machine, and the machine was about to test me in ways I never expected. There are 5 traps inside this machine. 5 stages every investor walks through. Most people get caught in one of them and never make it out. I got caught in all 5. Let me show you exactly what happened. Because if you understand these traps, you won't just understand investing. You'll understand why so many people work their entire lives and retire with nothing. Stage 1, the illusion trap. The first trap isn't about losing money. It's about never starting at all. Here's how it works. You tell yourself, I'll start investing when I have more money. I'll start when I understand the market better. I'll start next year, when things are more stable. Sound familiar? This is the illusion trap. And it is, without question, the most dangerous trap of all, because it doesn't feel dangerous. It feels responsible. It feels smart. It isn't. It's the machine's first defense mechanism. It convinces you that you're not ready, so you never step inside. Here's the part nobody tells you. I know people who have waited 5, 7, 10 years to start investing, waiting for the right moment, waiting to feel ready. And in that time, the market didn't wait for them. Let me give you the math, because the math is brutal. If you invest $1,000 today, and the market grows at its historical average, that money roughly doubles every 7 to 10 years. Not because you did anything, just because you let it sit. That means every year you wait isn't just a delayed start. It's a compounding loss, a silent tax on your future, paid in patience you didn't know you were spending. There's a psychological reason this trap is so powerful. Behavioral scientists call it analysis paralysis. The more options and information your brain has access to, the harder it becomes to act. Your brain isn't built to process infinite data. So when faced with too many choices, which stock, which fund, which app, which strategy, it does what it's evolved to do for survival. It freezes. And in the market, freezing isn't safety. Freezing is losing, quietly, in slow motion. I felt this trap myself before I ever put in that first dollar. I told myself I needed to learn more first. I read articles. I watched videos. I made spreadsheets I never used. Weeks became months. And one day I realized I wasn't preparing. I was hiding. Here's where it gets dangerous. The illusion trap doesn't just cost you money. It costs you identity. Because the longer you wait, the more you start to believe investing isn't for you. That it's for other people, smarter people, richer people. That belief becomes a cage. And most people die in that cage, having never even tried the door. So here's the mindset shift that broke me out of it. You don't need to be ready. You need to start small enough that being wrong doesn't hurt, and being right compounds. That's why $1,000. Not because it was a lot of money, because it was enough to be real and small enough that I couldn't hide behind excuses anymore. The machine doesn't reward preparation. It rewards entry. Stage 2, the impatience trap. Once you're in the machine, the second trap finds you almost immediately. I remember the exact moment. Day 3. I opened the app. My $1,000 had turned into $987. $13 gone. And something happened inside me that I wasn't expecting. My chest tightened. My mind started running scenarios. Should I sell? Is this the start of something bigger? Did I make a mistake? This is the impatience trap. And here's the truth about it. It has nothing to do with the market. It has everything to do with your nervous system. Your brain was not built for the stock market. It was built for the savannah. Thousands of years ago, if something moved fast and unexpectedly, it meant danger. A predator. A threat to your survival. Your brain still runs that same software today. So when a number drops on a screen, your brain doesn't see market fluctuation. It sees a threat. And it triggers the same stress response your ancestors felt when they heard a lion in the grass. Cortisol rises. Your thinking narrows. And suddenly, checking your portfolio 50 times a day doesn't feel like a bad habit. It feels like survival. Here's where it gets dangerous. Studies on trading behavior have found something remarkable. Investors who check their portfolios most frequently tend to earn the lowest returns. Not because they know less, because they feel more. Every red number becomes an emotional event. And emotional events demand action. So they sell during dips and buy back in after the recovery when prices are already higher. They're not investing. They're reacting. And the machine loves reactors. Because every time someone panic sells, someone else, someone patient, buys their shares at a discount. The machine doesn't create wealth out of nowhere. It transfers wealth from the impatient to the patient. I felt that pull on day 3. I wanted to check again. And again, I wanted to do something with that $13 drop, even though doing nothing was the correct move. Here's the part nobody tells you. The stock market doesn't move in a straight line. It never has. Even in its best decades, it drops 5, 10, sometimes 20% multiple times a year. That's not a malfunction. That's the price of admission. Volatility isn't the risk. Your reaction to volatility is the risk. So here's the shift that saved me. I deleted the app from my home screen. Not because I didn't care about the money, because I cared about it too much to let my nervous system manage it. I checked once a month instead of 50 times a day. And within weeks, something strange happened. The anxiety disappeared. Not because the market stopped moving, because I stopped watching it move. The machine doesn't punish you for investing. It punishes you for watching too closely. Stage 3. The comparison trap. The third trap doesn't come from the market. It comes from other people. A few weeks in, I saw a post online. Someone had turned $500 into $8,000 in 3 months. Some meme stock, some crypto coin, some can't miss opportunity. And there it was, that familiar feeling in my stomach. Am I doing this wrong? This is the comparison trap, and it's one of the oldest tricks the machine plays on the human mind. Here's the truth. For every person who posts their $8,000 win, there are 100 silent losses you never see. Nobody posts a screenshot of the money they lost chasing the next hot thing. Nobody makes a video about the account that went to zero. Social media doesn't show you reality. It shows you a highlight reel of survivorship bias. And your brain, again, running ancient software, wasn't built to understand statistics. It was built to compare. In a tribe of 50 people, comparison kept you safe, kept you status, kept you fed. But online, you're not comparing yourself to 50 people anymore. You're comparing yourself to the luckiest outcome out of 8 billion. That's not information. That's poison, dressed up as inspiration. Here's where it gets dangerous. This trap doesn't just make you feel bad. It makes you act reckless. People see fast gains from others and abandon slow, boring, proven strategies to chase the same lightning strike. They take their patient money and gamble it. And most of the time, the lightning doesn't strike twice. It strikes once for someone else while you're left holding the loss. I remember sitting there, staring at that $8,000 post, feeling like my slow and steady S&P 500 investment was somehow foolish, somehow behind. But here's the truth. That person with the $8,000 win, I never saw them post again. Not the follow-up, not the next trade, not what happened 6 months later. Silence. And silence, in this game, usually means the story didn't have a happy ending. The scientific insight here matters. Psychologists call this outcome bias, judging a decision by its result instead of its process. A reckless bet that happens to pay off still looks, statistically, exactly as reckless as one that doesn't. You're just seeing the version that got lucky. So here's the mindset shift. Stop comparing your chapter 1 to someone else's highlight reel. The machine isn't a sprint. It's not measured in weeks or months. It's measured in years, sometimes decades. The people who win aren't the ones who found the fastest path. They're the ones who never left the path at all. I stopped watching those posts. I stopped scrolling for the next hot tip. And my $1,000 kept doing the only thing it needed to do. Sit, grow, compound, quietly. Stage 4. The fear trap. The fourth trap is the one that breaks the most people. It happened 2 months in. The market dropped. Not a small dip this time. A real one. Read across every screen. News headlines using words like crash and collapse and recession fears. My $1,000 was now worth $860. And this time, it wasn't a flutter in my chest. It was fear. Real fear. The kind that makes you question everything. This is the fear trap. Here's the truth about this stage. It doesn't attack your logic. It attacks your identity. Suddenly, you're not thinking the market is down. You're thinking, I made a mistake. I'm bad with money. People like me don't get rich. That voice is loud, and it feels true. And that's exactly what makes it so dangerous. Here's where it gets dangerous. Fear doesn't ask you to think. It asks you to act. Immediately. Right now. Before it's too late. And that urgency, that desperate need to do something, is precisely how people turn a temporary dip into a permanent loss. They sell at the bottom. Not because the investment failed, because they couldn't survive the discomfort of watching it fall. There's a psychological concept called loss aversion, and it explains almost everything about this trap. Research in behavioral economics has shown that the pain of losing money feels roughly twice as intense as the pleasure of gaining the same amount. So a 10% drop doesn't just feel like 10%. It feels like 20. Emotionally. That's why fear is so much louder than logic in moments like these. Your brain isn't malfunctioning. It's doing exactly what it evolved to do, overreact to loss, to keep you safe. But the market isn't a lion in the grass. It's a cycle. It always has been. Every crash in history, every single one, has eventually been followed by recovery and then new highs. Not because of luck, because human innovation, productivity, and ambition don't stop just because prices fall for a while. I sat there, staring at that $860, feeling that same ancient fear. And I asked myself one question. Not, will this recover? But have I ever seen this pattern before? And the answer was yes. Every time. Without exception, in over 100 years of market history. Here's the part nobody tells you. The people who lose the most money in a crash aren't the ones who stayed in. They're the ones who got out and then didn't know when to get back in. They sell at the bottom out of fear and then buy back in after prices have already recovered, out of a different fear, the fear of missing out. They pay the price twice. So here's the mindset shift that carried me through. A drop in price is not a loss. It's only a loss if you sell. Until then, it's just the machine, doing what it has always done, shaking out the people who can't handle the ride, so it can reward the ones who can. I didn't sell. I didn't check the app for 3 weeks. And when I finally looked again, the market had already started climbing back. Stage 5, the compound escape. The final stage isn't a trap. It's the exit. But here's the twist nobody tells you. You can't reach this stage by trying to escape faster. You reach it by staying still. This is what most people never understand about the machine. It's not built to reward the clever. It's built to reward the boring. Let me show you what actually happened with my $1,000. Through the UPS, through the drops, through the fear, the comparison, the impatience, I didn't touch it. I didn't add drama to it. I let it sit, quietly, doing the one thing it was designed to do. Compound. Here's what compounding actually means, in plain language. Your money doesn't just grow. It grows on its growth. Year 1, your gains are small. Almost invisible. It feels like nothing is happening. This is the part where most people quit, right before the curve starts to bend upward. But by year 10, year 20, year 30, that same small, boring amount has multiplied not just once, but many times over. Not because you got smarter, because you got patient. This is the part nobody tells you. Compounding is not exciting. It's not a story you can post about after week 1. It doesn't give you a dopamine hit. It gives you a future. And those are two very different things. There's a reason Albert Einstein is famously, though probably apocryphally, credited with calling compound interest one of the most powerful forces in the universe. Whether or not he actually said it, the idea holds. Because compounding doesn't care about your feelings. It doesn't care about the news. It doesn't care about your fear or your excitement. It only cares about time. And time is the one resource the machine cannot manipulate, cannot crash, cannot take away from you. Unless you take it away from yourself by quitting early. Here's where the story gets powerful. My $1,000 didn't turn into a fortune overnight. It's not a rags to riches story. Nobody's making a movie about it. But here's what it did do. It survived every trap. The illusion that told me to wait. The impatience that told me to react. The comparison that told me I was falling behind. The fear that told me to run. And by surviving all 5, It did the only thing the machine ever really asks of you. It stayed in the game long enough to let compounding work. That's the entire secret. Not a secret at all, really. Just a truth so simple, most people can't believe it's enough. Time in the market beats timing the market. Every single time. The escape. So let's go back to the machine. Billions of dollars flowing through it every second. Rising. Falling. Testing everyone who enters. Most people think the machine is designed to make them rich. It isn't. The machine is designed to reveal who they are. The illusion trap reveals whether you're willing to start before you feel ready. The impatience trap reveals whether you can sit still while your emotions scream at you to act. The comparison trap reveals whether you can walk your own path, while everyone else's highlight reel plays beside you. The fear trap reveals whether you can hold on when every instinct in your body tells you to run. And the final stage, the compound escape, isn't something you achieve. It's something you survive into. I invested $1,000 in the S&P 500, and in the end, this was never really about that $1,000. It was about the version of me that put it in, nervous, unsure, doubting himself, and the version of me that came out the other side, calmer, steadier, someone who understands that wealth isn't built in a moment of brilliance. It's built in 1,000 quiet moments where you chose not to quit. The machine is still running. It's running right now as you watch this. And one day, maybe today, maybe next month, you're going to have to decide. Do you stay outside it, waiting for the right time, watching other people play? Or do you step in, small if you have to, scared if you have to, and let time do what fear never could? Because here's the final truth. The market has made more people wealthy through patience than through genius. It doesn't ask you to be the smartest person in the room. It only asks you to be the last one standing. Everyone else will get shaken out by impatience, by comparison, by fear. The machine isn't looking for the brilliant. It's looking for the ones who refuse to leave. So the question isn't whether the market will make you rich. The question is whether you'll still be standing when it does.